debt at its core is neither good nor bad. It's a tool. Like fire, it can warm your house or burn it down. It all depends on how you use it. Over time, people have come to view debt as something inherently risky or harmful, but that's a narrow perspective. Debt enables possibilities. It brings future income into the present, and when it's used productively, when it generates more income than it costs, it becomes one of the most powerful engines of growth a society can tap into.
Good evening, and welcome back to another episode of Bowls on the Table, where it's time to eat with financial fundamentals. I'm your host, Chef Erol Pearl at DBCHEFTV. Make sure to like and share this video. Also, subscribe to the channel and hit the notification bell so when I go live, you never miss an episode of Bowls on the Table. That was an excerpt taken from The Mind of Dalio, Ray Dalio. The link will be in the description. You can go and check out his page on YouTube. He has amazing insights, and I follow it. And it's something like I always say, it's not God, but it's gospel. So go and check that out when you get a chance. We're going to go ahead and get into our show. We're going to be talking about discretionary income, bank lines of credit, commonly known as a LOC. And before we get into that, we always want to see what's happening in the markets. So today, the Dow Jones closed down about a quarter, about 25 basis points. Looking at year to date, it is only up about 30 basis points year from the beginning of the year. And then we look at year over year. From this time last year, the Dow was up about 7%. We'll take a look at the S&P, closed down today almost about 40 basis points. Year to date, it's at 1%. And year over year, this time last year, it's still up about 11%, almost 12% from where it was last year. The NASDAQ, all the markets were down today. Not slightly down, not very much, but we had the NASDAQ that was down about 40 basis points. Year to date, it is down about 80 basis points, and then year over year, it is still up from where it was last year, about 14%. Let's check out crypto and Bitcoin. Bitcoin hit an all-time high today, I believe, of 107,000. I think that was the high. So go Bitcoin, go Bitcoin, go. Year to date, Bitcoin is up 13%, almost 14%, 13.5%. We'll take that. And year over year, Bitcoin is up 60%. Go Bitcoin, go Bitcoin, go. Let's check out the gold market here, see what gold's looking like. Gold is up about 40 basis points today. Year to date, gold is up almost 25%, and year over year, gold is still crushing it from last year, up 35%. So if you have any investments that are in gold, you are winning. Any investments that are in crypto, those are the two markets that are crushing it right now. And it's probably due, I wouldn't even say probably, it's due to a lot of the things that we see going on in the economy with tariffs and everything else. Real quick, we're want to check out something real quick. We want to look at silver. We want to see what silver's doing. Silver was up today about 35 basis points. We got year to date, silver's up 13.8, and then year over year since this time last year, which really means that silver has pulled back. So I mean, it's still, when you look at, where it's been, silver's still on sale, y'all, and it is a natural resource. It's used in so many things that we consume. So it's something to look at, and there are plenty of options to invest in silver. Let's go and check out crude oil real quick. Today, crude oil was barely up from where its previous close, and year to date, it is still down almost 13%, and year over year, it is still way down from where it was this time last year. I think oil is coming down a lot more. We heard some news about Saudi increasing the OPEC conglomerate. They are increasing their output, and the commander in chief has already said drill baby drill. So the more that comes available, it seems like, the cheaper to get. That is what's happening in the markets. So let's get into our first part of today's topic: bank lines of credit. As you saw in the title from the thumbnail, pay off your mortgage. We want to pay it off using a bank line of credit. Let's pay it off fast, right? And most people think like, well, how can I pay this off fast? What do you mean pay it off fast? A lot of people sell your dream. There's nothing is fast. That's just something to, get people to actually be interested, in a quick method. But anything that is good takes time. Just like cooking a good meal, it takes time. It takes time to prepare it, and it takes time to cook it. Another story for another time. Today, this bank line of credit, we want to pay off our mortgage in less time. What do we mean by that? What we mean by that is, if I get a 30-year mortgage and I take the whole 30 years, you're going to end up paying double. And you say, what? You're going to end up paying double? Your interest rate that you receive only determines what your monthly payment will be. So if you got a 5% interest rate, 3% interest rate, 2% interest rate, 7% interest rate, 10%, 11, 15, doesn't matter. That only determines what your monthly payment will be. That does not determine what you will pay over the course of the loan, that whole 30 years, if you take 30 years to pay off that mortgage. The first thing we are going to do is we want to learn what is a bank line of credit. And in order to do that, before we get into the rest of this list, we're going to watch this video.
A line of credit is an arrangement where a bank offers a maximum loan amount that the borrower can draw upon at any time. The borrower, which can be an individual, business, or government entity, has the flexibility to take out as much as they want, up to the maximum amount. Lines of credit have a couple of important advantages. First, borrowers are only charged interest on the funds they actually draw. This is what differentiates lines of credit from traditional loans. Also, the interest rate, which is typically variable, is often lower than that of a one-time loan. Take Evan, who owns his own business and therefore has irregular income from month to month. He applies at the bank for a personal line of credit worth $10,000 just in case he runs low on cash for a period of time. After checking his credit history, the bank agrees. If Evan only draws $1,000 from his credit line, he's only charged interest on that withdrawal amount. He sleeps well at night knowing that $9,000 of credit is available in an emergency. If he took out a traditional loan on this amount, he would be charged interest on the entire loan amount for $10,000, whether he uses the funds or not. Most personal lines of credit are unsecured, so they don't require collateral. Your credit card is an example of an unsecured line of credit. The popular home equity line of credit is an example of a secured line of credit where the bank places a lien on your property. The lender takes on less risk because of the lien and therefore offers a slightly lower rate. One pitfall of a credit line is that borrowers may be tempted to draw more than they actually need, since the funds are readily available. As with any loan, borrowers should evaluate the pros and cons before applying.
And that video is on investopedia.com. You can go over there. But what we're going to do right now is we're going to take a look at investopedia.com, because we're going to dissect that just a little bit. We're not going to go too far into it, but we want you to have some of the information and some help to be able to navigate through this. A line of credit is a preset borrowing limit offered by banks and financial institutions to their professional and business customers. Okay, to their personal, pardon me, to their personal and business customers. All right, so how I am suggesting that we utilize this to pay off the mortgage. You will be going in to get a personal line of credit. All right. What that means is they will be using your credit worthiness, which is your credit score. Do you pay your bills on time? That's what you would be leveraging. You're going in saying, hey, I would like this line of credit. Now, when you go in and you apply for this goes back to credit and budget discipline. All right. You need to know what your credit is, what your credit score is, what shape your credit is in. Okay. You need to have a budget. If you don't know what your credit score is, 9 times out of 10, if you are messing up and your credit is not where you like it or where it should be, where it will help you qualify for something like this, then you probably aren't exemplifying budget discipline. So I can't suggest to you what is the we say like that the end all be all answer. All right. But you have to look at your budget and make the necessary cuts and decisions to it that allow you to have your credit in place and your budget in place for you to be able to access this. All right. And one of the main things that we have right under what our goal is at the top is job security. Right now, we are in a time where we see massive layoffs. I believe Microsoft just laid off 6,000 employees. UPS is looking to lay off some more. And you can just, do a YouTube search, a Google search, any search engine that you use, and you'll see that these layoffs are real. That it's called employee downsizing, and it's continual. It's really been going on since 2023, to be honest, y'all. So this isn't, it may be new to you, but I've been paying attention to it for the last 2 years because it has just increased. Just because you don't know somebody who's affected doesn't mean that it isn't going on. So job security is going to be the first thing. You can't pay for anything, your lifestyle or anything, if you don't have employment. Lines of credit can be used at any time until the limit is reached. The reason why you want to do this specifically using a line of credit is because you'll be able to pay the line of credit back, like they said in the video, and then you'll be able to keep reusing it. Okay. And this is why you want to use this tool specifically. There are other tools like the video described, like a home equity line of credit, a HELOC. But in that case, you're using your home as collateral. So let's say you went through something, you using a HELOC and you borrow from it and you lost your job security. Not only do you have a mortgage that you have to pay, but now you've borrowed against your home and now you have to pay that as well. So if you don't pay the HELOC, then guess what happens? You could lose your home. I don't recommend you do that unless you have budget discipline. Okay. If you don't, if you know yourself, know if you are a person that, spends and worries about it later. You have to know your habits. If you don't know your habits, then this isn't for you. This is for someone or for those people who are looking for ways to utilize debt to benefit from it. And that's what we're talking about here. How to use a line of credit to pay off your principal of your mortgage. Okay. As money is repaid, it can be borrowed again in the case of an open line of credit. I'm going to say that over one more time. As money is repaid, it can be borrowed again in the case of an open line of credit. The borrower can access funds from the LOC at any time as long as they do not exceed the maximum amount, which is the credit limit set in the agreement. Okay. So bottom line. All right. Consumers and businesses rely on credit to make large purchases, keep their operations going, or make investments in their growth. And this is what I'm talking about here, making an investment in your growth. So an example, how I would give you how I would use a line of credit to pay off my mortgage. Okay. Here's an example. So I would get the line of credit. Okay. One of the tools that was shared with me when you go and you apply for a line of credit, when you apply, when you're speaking with the representative on the phone at your bank, whoever you call, whatever banking institution or lending institution that you're going to apply for this line of credit, you ask them specifically in these words, what is the maximum that the underwriter is allowed to sign off on for a line of credit? What is the maximum that the underwriter is allowed to sign off on for a line of credit? The reason why you ask this is because you don't want to go in and be like, hey, I need 25,000. And then they say, okay, well, we can only give you 10. Once you go through and run your credit and everything, you want to know what the max is. You want to apply for the max, ask for more than what you need. All right. And allow the bank to determine what they will give you based on your credit worthiness and how you present your credit history and everything in your application. Okay. Now, just because you get that amount doesn't mean that you use that amount. You use the amount that you know that you have enough discretionary income to be able to pay it, because there is also going to be an interest rate attached to that line of credit when you withdraw money from it. All right. So let's say you have $20,000, all right, of line of credit, a $20,000 line of credit. So I have a $200,000 mortgage. All right. I'm going to take $10,000 of that line of credit, and I'm going to apply it to my mortgage, to the principal. Okay. Specifically the principal. Now my mortgage is at $190,000. Okay. I have let's say 6% interest rate. What that does now is that reduces my monthly payment. So if I was paying, I don't know, $1,700 a month, maybe $1,500 a month, maybe something in between that range, that's going to lower, because my interest rate is now being charged against this principal that I have reduced. So it lowers your monthly payment. Now, yes, I do have, they say, well, what about this $10,000 that I borrowed now? How do I pay that back? Because I still have to make my monthly payments on my mortgage, right? Well, you have what's called discretionary income, not to be confused with, what do they call it? Disposable income. Okay. So what is discretionary income? Okay. Now, a lot of people don't even know what that is. So let's get into discretionary income so you can understand that.
Discretionary income is an economic term referring to income left over after a person pays taxes and living expenses. Discretionary income is often confused with disposable income. However, discretionary income is derived from disposable income, which is income left over after taxes are paid. Discretionary income is calculated by subtracting normal living expense from disposable income. Discretionary income usually falls and rises in step with the health of the economy as a whole. In a consumer-based economy, discretionary income is important because the higher it is, the more robust the economy tends to be. By raising the price of necessities, inflation reduces discretionary income, which in turn becomes a drag on the economy. Economists monitor discretionary income so they can help policymakers set policies that increase discretionary income and spur the economy. For instance, if economists forecast inflation that might cause increased prices for necessities, policymakers might try to offset the increase with a corresponding decrease in taxes so that the two changes offset one another and discretionary income levels are maintained.
So that's a quick video on discretionary income. The link will be in the description. You can also find that at investopedia.com as well. All right. So let's look into discretionary income. Let's dissect that a little bit. All right. So discretionary income is the amount of money that you have left for spending, investing, or saving after you have paid your taxes on your wages, after you have paid your car note, your food, your housing, your clothing, whatever the babies need, whatever your vacation is, whatever, all of those things. If you have some money that's left over, that is your discretionary income. All right. So you should be saving. Here's the kicker, right? If you don't have a budget, then how do you know? You're just getting paid and you're just spending money. And that's why this is so important. That's why this is right above. That's why this is right underneath job security, your credit and your budget discipline. Because if you don't know, then you can't do this. It will be completely impossible because you're just a spender. You just spend money. You don't even care. Like, okay, I'm just going to make it work. I'll figure it out. We'll figure it out. That mindset, you're going to be struggling your whole life. The focus is wealth strategies, how to build wealth, have more discretionary income, or what we call cash flow, right? We can get the cash flow in some things. You need to have some assets to have a cash flow. And discretionary income can come from that because those assets that you have that you cash flow have maintenance costs. They have things that require taxes. They have all of these things that are required to maintain them that cost, just like where I live. I have to have clothing. You have to have food, right? Like it costs for us to maintain ourselves, to live, right? But the money that we have that's left over, that is your discretionary income. That is the things that you could, like it says here, discretionary income includes money spent on luxury items, vacation, non-essential goods and services. What does non-essential goods and services mean? Non-essential goods means like I really don't need it, but I want it. Like I need a pair of shoes, but I don't need, the $300 or the $1,000 pair of shoes, but I need a good pair of shoes. So all of these types of things like that are non-essential, and for some people, they have said that these things are essential. So, if that's the way you feel, live life. However, what I'm sharing here today is a way that for most people, we buy homes and we are stuck in 30-year mortgages and we end up paying double. Understanding that the amortization of your mortgage shows you that it's not a conspiracy. It is not like, oh, this is bad. I mean, maybe it is bad, but this is how the system works. So understanding how the system works and then having tools to navigate through it better will empower you and help improve your quality of life, and help you keep some money in your pocket for some of these non-essential things that you may want to do in life, like luxury items and vacations and things like that. Because discretionary income is the first to shrink after a job loss or a pay reduction, businesses that sell discretionary goods tend to suffer the most during economic downturns and recessions. So we're seeing this now, and this is why I'm sharing this information, these tools, these resources, these disciplines, these wealth strategies, these financial fundamentals, because we're in the time now. Like it's happening around you, whether you're paying attention to it or not. There are people losing jobs. We have trade wars where there are supplies and limited things. People been going to the store, and I know it's a couple products that I use that have been discontinued, just in the last 2 or 3 years. Those goods, what tend to suffer, those companies had to go out of business because they couldn't pay employees. They couldn't produce those products. Some people that maybe purchased those products, they had to reduce it because maybe they lost money. Maybe they lost their job. Maybe they retired and got on a fixed income, and they said, okay, well, this $12 item, was something that was a luxury for me. But now that I don't have that much, maybe I have to find an item that's comparable to it, but it costs, $5 or $6. So then they stop spending money on that particular $12 item. Okay. And that came from a shrinkage of their disposable income. All right. So going back to this bank line of credit, discretionary income or cash flow, and then understanding your amortization. Understanding the amortization is because this is where we end up paying the most. This is where everyone pays double if you take the length of the mortgage to pay it. So if we take this bank line of credit and we apply a portion of it to our principal, then what that will allow us to do is reduce the principal of the mortgage. And then we take our disposable income. So let's say you have, after you pay all your bills and everything, all right, you put a little money away for the vacation. If you got a vacation savings plan, you put a little money away in your 401 or in your IRA or, whatever it is. And whatever money you have left over, you've paid your car note, you paid your insurance, you paid whatever, all right, whatever that is that's left. And that's why a budget is so important. You take that money and you say, okay, this is the money that I'm going to use to pay back to myself in my line of credit. That's what you use that money for. You don't just put it in a bank where it's not making any money for you at 0.0001% interest. That's not doing anything for you. That's not doing anything for you when you saving $1, but then next year, when you go to the dollar store, it's the dollar no more store. It costs $2. So that dollar at 0.0001% interest just sitting in the bank is not going to buy you the same amount of goods because the cost inflation, because it went up. So yeah, you get to look at it and feel good and think you got something, but actually you just getting poor because you're not using your money as a tool to, one, pay down or pay off your liabilities, your debts, or use that debt to pay off the other debt. So this is what happens with this discretionary income that we just like to look at. Sometimes we like to leave it in the bank to look at it, to think we got something going on. With this particular, and like I say, I'm not a financial advisor. Always seek professional advice from a financial advisor before you make any decision. But do your own research on this. You can use the bank line of credit. You have to have your credit in order to walk in the door and get any loan from anywhere. Okay. You can apply this to your principal of your mortgage. And potentially every time you pay back yourself, pay that line of credit back up. You got $20,000 line of credit. I'm going to take 10. I'm going to put 10 on my mortgage. I'm going to take my discretionary income. I'm going to pay that 10,000 back to my line of credit. Okay. Then I'm going to take another 10. I'm going to put it back on my mortgage. I'm going to take my discretionary income and I'm going to pay that back. All right. I'm also during that time going to be looking for other ways to increase my income, to increase my cash flow. All right. But just using this simple tool can allow you $10,000 at a time, 15, 20, whatever is good for you. All right. You have to know how much you make and how much discretionary income that you have. Okay. There are plenty of other strategies that people suggest to do this. I say do it from your discretionary income. That's my suggestion. That's from my personal experience, how the best way to do it. Okay. Without taking a loan against your home, because if something happened and you lose your job, well, I still want to be able to have my home. I don't want to have took a lien or a loan against my home, and now I have to worry about that. Am I going to lose my home because I can't pay the mortgage, or am I going to lose my home because I can't pay the loan that I took out on the house? In the worst case scenario, if you can't pay the bank back, you lose your line of credit and your credit is messed up for a few years, but you still can go and find resources and ways to pay your mortgage and stay in your house. Just to recap, we talked about a bank line of credit. Why do we want to use the bank line of credit? To pay off our mortgage in less time. And what things do we need? We need to have job security. We need to have credit and budget discipline. We need to make sure that we have discretionary income or cash flow to be able to pay the loan back. And we need to understand an amortization schedule of our mortgage. This is one of the biggest things. And, people will live long enough and they'll pay their home off, but they paid twice the amount because they didn't understand these tools that are available for us. And they had outstanding credit, but they just didn't know how to use the debt to pay off the other debt. That OPM, that other people's money that we hear about, this is one of those strategies. And it's many of them, and we are going to be sharing many of them in the future. But I hope this was helpful to someone out there. And I suggest that everybody go and do your own research. These tools are available for us online. Investopedia is there, and you can speak with a financial advisor, and I'm sure that they have plenty of strategies. But that's all I have for you today. Thank everybody for watching. Make sure to like and share this video. Also subscribe to the channel, hit the notification bell, so when I go live, you never miss another episode of Bows on the Table. Make sure to have a peaceful, positive, and productive rest of your week. And I will see y'all next time right here on Bows on the Table.
Sign up for the newsletter and shop merch and clothing at www.dbcheftv.com.